Today we'll be going through a topic that is on a lot of our investors and the clients that we work with. It's always front of mind, and that is, where are we going to be buying properties within the Melbourne vicinity within that $700,000 price point? So in today's session, we'll show you exactly how we would look at the data, how we would interpret the data, and where we would be recommending people to consider a purchase, again, subject to a brief that we will take you through today. My name is Nick. I'm one of the directors here at Handle Properties. We are a boutique buyers agency. There's just two of us in the business, so we'll be dealing with you directly in our engagement. And we focus on buying residential properties between that $400,000 and $1 million mark. We've secured over 80 properties so far, and both AJ and I are successful investors in our own right. We both had more than a $5 million portfolio each, and we've achieved this really by working full-time corporate jobs and on single incomes. So by no means have we been on single incomes. At Handle Properties, we very much focus on the data, not the hype, but also we do lay our own fundamentals and our own thesis around the data so that we can reduce the risk and give you confidence in buying a property. So today I'm going to walk you through how we would analyze all of the available pockets within Melbourne and how we would think about growth potential, the risk factors, and long-term viability. And before we get started, I want to anecdotally share with you what our view is on Melbourne versus perhaps Sydney, where a lot of our clients and investors, a lot of our questions do come from. So Sydney, for example, as you can see, east, we are blocked by an ocean. The north, west, and the south, Sydney is basically landlocked by a national park. So what that basically means, the ability to continue to expand into the fringe and keep building more and more housing is in essence a bit more of a challenge based on Melbourne. So if you go back to Melbourne, you can kind of see it's a very different city geographically to Sydney. And the reason why I'm comparing Sydney and Melbourne is because they've always been seen as competitors in terms of the capital growth and the growth potential within the Australian context. So you can kind of see here in Melbourne, you really only got National Park coming well out into the north and northeast regions. However, Melbourne is a capital city that continues to expand. It's relatively easy for net new housing to be created in a lot of these areas, lots of empty farmland. It is really just a function of construction costs as well as permit and housing supply will continue to come up. Melbourne is very, very good at building houses. So taking that into account, it's why we're a little bit more hesitant in terms of the due diligence that you do specifically for Melbourne, because it's very easy to get it wrong and buy into an asset, and 5 years, 7 years, 10 years later, you will still be holding that same asset at the same value or even less. So our data-led approach will help us filter down to the right locations, but then we do have to layer upon our fundamental analysis to find those locations in detail. And before we step into it, please head over to our YouTube page. We do have a number of videos that we've started posting. More will come up, and we want to be more specific and transparent in our process of how we operate, how we find projects, how we find suburbs and properties to invest. So click subscribe or like our video, hit subscribe, and we look forward to seeing you in more of these videos. So back onto the mini agenda. So before we get started in terms of finding these properties, we first have to understand the brief of the search. The brief, or how we start the search, is the underlying basis as to what makes a particular suburb and a particular property investable. So if we blanketly look at a suburb and say, hey, that suburb is better than this suburb, we don't want to know the context why. What was the client's budget? What was the equity need? And so forth. So for our analysis today, we're going through a scenario where the budget is $700,000 plus costs, so thinking all of your transaction, stamp duty costs and whatnot. The equity release time, so this is the time from when you buy the property and when you want to extract the equity to, in most cases buy another property or, help pay down some personal debt or whatever it may be. That is within 5 years. The overall hold time of this asset is 10 or more years, so the overall hold time that you'll hold this property. And also, an operating budget of $2,000 per month. So this is after all costs. This is how much you can set aside to own this property. And of course, that's pre-negative gearing, but it gives you an understanding of the constraints of how we are searching for a property within that $700,000 plus starting point. So we will start with showing you a tool that we use called HTAG and how we can start layering upon these data points to make it much easier to start buying properties in this price point. So heading over to HTAG, let's build it from scratch so you can see exactly what goes on in the back end. So first, I want to see every single column about a particular suburb. So let's put all of these in. So as you can see, there are a lot of data points that you can get really, really detailed about. Some are more relevant than others, some more distractions than they are actual data points to worry about. So we typically look at about a dozen of these data points to start the search filtering process. So now we have all of the columns in for all of the suburbs around the country. So there's about 15,000 suburbs. Now we want to start on properties within that $700,000 median price point. And we also want to be looking at suburbs. We also want to look at houses, and it must be all houses. We're not worried about 2-bedroom houses and whatnot. We focus on 3 and 4 bedroom or more, but we'll use this filter here. And this is where you can filter it down into the specific state, because obviously there are a lot of suburbs around the country that can fit in this region. So we want Greater Melbourne, and within Greater Melbourne, when we get to it, we can do more filtering, but we'll leave it at that for now. The next data point that we really care about is the yield. We want to be starting with yields greater than 5%, but I'm going to start with 4.5%, because if we get a suburb that has a yield of at least 4.5%, that will be a good starting point. So we want to start with suburbs with at least a yield of 4%. We want to be aiming for the 4.5s and 5s, especially in the current market. It's a little bit more challenging, but at least at this point, we can start looking at suburbs with at least 4% yield. And you can kind of see here, out of all the suburbs available, within Melbourne, there are only 50 suburbs that have a median price that is less than $700,000. And then the moment we add the yield filter on it, that immediately comes down to 18 suburbs. Now, we are also really keen on the building approval ratio. So that is how many incoming stock is coming into a particular area. So we want that to be less than 3%. We also want another function of supply to be the inventory levels. So we want that to be less than or equal to 3 months. So that basically means if no more listings came up, how long will it take for all of the properties that are listed to currently be sold? The next data point to focus on is the RO ratio, or the rental to the owner-occupier ratio. And that is so that we can find areas where there is a majority owner-occupiers, because owner-occupiers are the ones that actually drive up house prices. So we want that to be more than 50%. So you can kind of see here, we're getting very, very close to the various areas that we can invest in Melbourne purely on a data-led point on some of the core data metrics. We do have another YouTube video that I'll put in the links below that goes through, if your brief is much larger and you want to know exactly how to go from a brief to 15,000 odd suburbs around the country and all of the various risk overlays and data points and fundamentals to look at to get to the 2 or 3 investable suburbs, there'll be a link in the description for that for later. But as you can see, through this process, we have already started to find, here are 13 suburbs that you could potentially invest in that are already showing signs of being a high demand suburb. Now, within these areas, you now want to start layering upon other important functions. So you want to be looking at things such as, have there been enough sales in an area to give you good statistical reliability? So that's one way you can start filtering out and trying to shortlist these areas into the top 2 or 3. So as you can see here, some of these areas are getting lots of sales, not necessarily areas that you would want to be investing in, and I'll tell you why. Even though supply is relatively low, you also want to be focusing on rentals being strong. You also want to be focusing on rental growth over the last 12 months. As you can see here, over the last 12 months, these suburbs have shown that rents have gone up between 6, 7, and in some cases 11%. So very, very strong rental growth. And again, it's an opportunity to ride that momentum. And as the area continues to gentrify, you can continue to increase the rent. And there's lots of other data points in here, and which in the most part is a distraction. So we want to focus on the key ones that you should care about. RO ratio in, you can see here, we have 13 suburbs that we can technically consider to invest with some of our core metrics for good, solid capital growth today and tomorrow. Now, to overlay upon this, we want to be buying into the momentum. So look for areas where that price trend is starting to reverse, especially in Melbourne. We're very much at the bottom, plus or minus 6 months from where we are. And you can kind of see here, we're starting to turn around and our markets are starting to move positive, especially over the 1 month and 1 quarter period. And then also you want to be looking at areas where the rentals continue to climb upwards. So over the last 6 months and 12 months, a lot of these areas have had strong rental growth, which is fantastic. But now you've got these areas, you want to focus on where they are within Melbourne. So you've got Melbourne West, typically the Melton region. You've got the Peninsula down south. You've got Melbourne Northwest, which is where we're going to focus on, and I'll tell you why. So let's dig in to the data points or the reasons why we are particularly excited about Melbourne Northwest and why we would bring that into our analysis. So once you've got your core layers done in HTAG, you now want to start adding on the fundamentals. And that is, in our opinion, the key one to focus on is the infrastructure projects. So you want to follow the money. You want to follow where governments and private enterprises are spending dollars. That means they're either going to be spending it on a construction phase. So that project is currently being constructed. So a lot more construction dollars and jobs coming to that area. And depending on the project, once it's completed and delivered, think about the economic activity and the new jobs and the new economies that will come as a result of that particular project. So going through that, the areas that we have come up with is the Melton region up here. So a few of those came up in our list as sub $700,000 with yields above 4%. We've also got this area up here. There you go. So we've got Broadmeadows, Jacana, Dallas, Meadow Heights, Coolaroo in this region up here. Very much came up in our filtering. And we also have the peninsula down south. So Hastings and Frankston and Capel Sound. So that is around this area here. So you want to be focusing on government infrastructure. So as you can see here on the Vic Roads big build, there is government infrastructure that is currently, we want those that are in planning or under construction, because that's almost immediate and foresight that you can kind of rely upon. So you can kind of see here up in the north where we have the Coolaroo area, you've got a new airport train link that's coming through, and you've got a new super station coming through as a super hubs. And you've got a new train station upgrade coming through in Broadmeadows to basically make it a hub in 4 different traveling directions. So that's always a plus point. And down south, when you go to Frankston, yes, there isn't really much happening here. There are smaller scale projects happening in the region, but you can kind of see from a tick boxing basis of infrastructure projects, our focus would be in this area. I must also say there are other sources to look at. We have to dig deep into the details. For example, in that Melton region, there is a $900 million hospital project coming through, and we're going to make a video on that in terms of where we see the Melton market moving, considering where approvals are and where yields are and where the relative affordability is. We do have a very strong view on this Melton region. So once you've got the infrastructure projects here, you can kind of see we are more inclined to be buying in this northern region because that is where we can see a bit of government spending coming in. That's always a plus point. So once you've got infrastructure projects in, let's start talking about actually finding property. So based on the overlays and the fundamentals of the infrastructure projects, you can see that there is an inclination to be looking in Melbourne's northwest. So let's start looking at properties in this area. So Dallas, Coolaroo, Campbellfield, and Broadmeadows. And we want to be focusing on properties up to 700,000. We want at least a 3-bedroom. We want at least 500 square meters of land. especially because you can do a granny in Victoria on any property more than 450 square meters, subject to the setbacks from the fence. And we want to focus on private treaty sales and exclude properties already under offer. Now, as you can see here, after doing this search, it is really, really tight. There's only 12 properties that you can potentially buy in these regions that tick all of the boxes. And that is the challenge, everyone. Every single buyer's agent and switched on investor are using tools like this and coming to the same conclusion. So the challenge is, how do you shortlist properties effectively and quickly and be able to make an analysis as to whether or not you should be a part of the offer process and bid? So going through this area, you can see here, we have Dallas. Let's open up a few properties. As you can see, they're definitely all in that high 600s range. And when you're choosing these properties, it's super important to just know that we are close to the airport. There will be a bit of noise pollution, something to keep in mind. But again, it's not a deterrent. You know, Sydney has an airport right in the middle of the city, and all around that airport, those properties are worth a lot of money. So it's not something to be super worried about, but it is something to be mindful of. So here we go. Indicative price, $590 to $610. I can guarantee you this is a complete clickbait. This property will go in the 650s. But as you can see, 3 bedroom, 1 bathroom, double garage, overall neat, tidy block, 530 square meters, a bit rough around the edges, but that's what you can kind of expect to pay for in Melbourne, in this region. Fortunately, that there is decent kitchen renovation. It does need a lick of paint at some point. It does need a bathroom upgrade at some point in the near future, but overall a neat, tidy block. It's well situated, it's relatively close to the CBD, and you know, you can see here the road is not the biggest, but it's not the smallest either. Now again, not saying that you should buy this property, but just looking at some of the high level things to kind of look at when you are shortlisting these deals. Oh, there's only one image here. Let's move on to the next one. Here we go, 620 to 665, a bit more realistic for the area. I can see this trading in this price range, probably middle to top, but much more value for money. You've got a 4 bedroom, 2 bathroom, 2 car spot, not garage, on a decent 639 square meter block. And it has been repainted on the outside. Again, rough around the edges on the inside, but something that you can, you know, rent out. It definitely does need a new kitchen. Okay, is this even the kitchen? Guys, I'm doing this, everyone, I'm doing this live. I have not prepared this up front, so you can kind of see exactly what to look at when you are looking at properties from the get-go. And it has a granny flat on the back. So let's exclude this one. That granny flat is not something we want to buy into. It is probably something, I would not touch this one. That granny flat, here we go, that's the granny flat. So gosh, that is the granny flat. So you would not want to be touching this, or you can't value this as a property with an additional granny flat, because that is not a granny flat. That requires a lot of work. It's probably not legal. You're probably taking a massive risk buying into this property without the right permits. But as you can see, the remaining buildings aside, the front property seems to be in good nick. Rough around the edges, might need some renovations in the short to medium term. This property is probably a little bit more alike in terms of what you would consider. Yep, neat, tidy, kitchen, bathroom, clean, neat, tidy, really weird configuration. It will stop you from doing a granny flat. It's just harder to get side access and get something in. A bit more challenging, but overall, if we were to focus on the first 2 properties, so 10 Edmund Street and Dallas, and 20 Wedding Court in Broadmeadows as targets for our pick, we can start doing the numbers on this particular property. So now we found the properties, let's start doing the value for money check. So as you can see here, how we would see value for money is from a pure replacement cost perspective. So in this case, you can see here, you're paying for a 40-year-old property in both situations. There'll be very little building value in this, and we would say you're paying about $450,000 to $500,000 of the purchase price towards the land, which leaves the remaining value of the property of $200,000 as the building value. So now if you think about replacement cost, yes, if you wanted to build a brand new property in this area, it might cost you, $400,000 to build something comparable. But in the current state, you're getting a property you're getting the land for about $500 and the building for about $150,000, $200,000, well below replacement cost. So that's a good thing to look out for. It means we are buying below replacement cost and we have a large component of this transaction dedicated to the land. Now, the next question is to actually run the numbers to see if this property will be within our budget. So let's just do it on the first one being 10 Edmund Street in Dallas. Let's run the numbers here. Although it's got 590 to 610, it's probably going to go for the mid 600s. So let's put in a purchase price of $650,000. We are looking at a 4% yield as a benchmark here. So going back to HTAG, you can see here the rental yield is 4.3%. So let's use that as the benchmark and divided by 52. So it's about $530 per week. Let me just zoom in for everyone. About $530 per week. Assuming a 20% deposit, assuming standard transaction costs and that deposit, you're looking at $187,000 upfront to buy this property. You will probably get a loan just for the balance of your deposit, and scrap that editor, will end at $187,000. So now using these numbers, and we've already pre-filled some of the standard property management costs, water rates, general repairs allowance, insurance costs, and land tax within Melbourne, you're looking at a gross yield of 4.24%. at $530 per week, which will give you $27,000 a year, $48,000 worth of expenses. A big function of this is the mortgage interest rate at 6.3% on the remaining 80%, which will leave you with a $21,000 out-of-pocket expense to hold this property every year. That is well within our brief and our budget of $2,000 a month. So $1,700 per month. And this is on an interest-only loan. If you needed a principal and interest-only loan, you can kind of see here, you need to put up an extra $9,000 a year at a higher interest rate to be paying down the principal as well. But on an interest-only loan, it is well within the budget of $2,000 a year, not taking into account depreciation or any tax benefit. So let's say on a property like this, very small conservative depreciation amount of, let's say, $4,000 a year. And let's say you are in the 37 cents on the dollar tax bracket, you will get a refund of $9,000 a year, which will bring your post-tax operating cost to just under $1,000 a month. So thinking about that, you are able to buy a property in the inner ring of Melbourne within $700,000 on a 20% deposit, and it will only cost you $991 a month to own, or a negative cash flow of $11,000 a year. Now, where Melbourne is in the cycle, very likely it could be worth $800,000 to $1 million within the next 3 years. And the real catalyst for that is the drop in interest rates, a couple more rate rises forecasted, a change in the demographics where we're seeing growth in rental yield. So what's already a 4.2% rental yield could increase by 10%, and you're getting closer to 5.5% in the next 3 years. And of course, you have the ability to keep paying down the loan to reduce your overall costs. But the real question here is a total cost of $11,000 a year with an average growth rate of 7% a year means you are growing your equity on cost by approximately $50,000 a year for a total cost of $11,000. So your cumulative return is $21,000 a year on a total outlay of $187,000. So again, you're getting a 17% cash on cash return after all costs and equity to own this property. And before you know it, this property will just accelerate with compounded interest over time. Just give us a yell. We would be happy to share this copy with you. So this is how we would go through the process of shortlisting suburbs, using HTAG, adding overlays, looking at the fundamentals, looking at the specific properties available within an area, shortlisting properties at a very high level of what we would and wouldn't buy. Obviously, when you do engage us, we have a very detailed checklist of how we further dissect these properties, looking at aspect, looking at development potential, looking at easements, looking at flight over parts, looking at the ability to extract immediate value. These are all of the checks that we do before we'll present you with a single option. And of course, finding these off market and then actually putting all of those numbers into a spreadsheet to see exactly what your ownership costs could be. So there you have it. There is a Handle Properties breakdown of properties in Melbourne where we're seeing opportunities under that $700,000 mark. And as always, we don't rely on hype or hot tips. We focus on data-backed property investing that matches to the client's brief and also your long-term goals and plans. So if you're an investor looking to buy in Melbourne or anywhere in Australia and you want help sourcing, assessing, or negotiating the right property on your behalf, we'd love to help. Thank you for watching, and I'll see you at the next one.